Welcome back at 7:41. Interest rates could be going up even more than anticipated. Federal Reserve Chairman Jerome Powell says the Fed may need to hike rates more aggressively to tame inflation. Joining us to break down what this means for you, your wallet, and your family is Professor of Economy at Northwestern, Martin Eichenbaum. Professor Eichenbaum, thanks for starting your Friday with us. Appreciate it.
My pleasure. Always happy to help.
So help us try to understand here from 30,000 feet. We go to a cocktail party, we have a family dinner, and we talk about these things, about interest rates and why they keep going up. Kind of at an elevator pitch, explain to us where we're at right now and why we're at where we're at.
Well, the inflation has been running much higher than the Fed's target of roughly 2%. The economy is very strong. Today's employment report, again, was very strong. So we're in a situation where inflation is running pretty hot, much hotter than the Fed's target. And the Fed is deeply concerned about that deviation of inflation from where they want it to be, primarily because high inflation rates are just devastating to workers and normal people.
So then what do we make of Federal Reserve Chair Jerome Powell's comments saying that the economic data is stronger than expected and that interest rates are likely going to be higher? Does that just fall in line with exactly what you're talking about? As long as inflation is running at that clip, we're going to see these interest rates chip up and up and up.
I think that's right. The Fed was behind the curve in 2021, and inflation was higher than they had expected. They have quickly turned around and said, look, we can't let this go on. It's hurting too many people. So as long as those numbers keep on coming in stronger than they expected, and there are pressures on on labor markets, et cetera, the Fed is absolutely determined to slow things down so that everybody can catch a breath and minimize the damage from ongoing inflation.
And you touched on this out of the gate, but this just came into our newsroom and probably onto your computer screen about, 40 minutes ago. The February jobs report is now in. The labor market remains strong, as you say. Is the conventional wisdom that what Powell is doing is universally agreed upon, or as close to universally agreed upon as we can get in this country, given the fact that this is really the only antidote for this level of inflation?
I think politicians from time immemorial have looked for a magic bullet. Somehow can we magically get rid of inflation? And it really is the conventional wisdom in central banks around the world, and I would say many politicians, but not all, that we've just got to slow things down. You know, we're at an all-time low rate of unemployment, or at least for the last 60 or 70 years. And the pressures that are building up are just not sustainable if what you think is you want a 2% inflation rate.
So if somebody has to make a larger purchase right now, let's say they get laid off or they have to move, and they're ready to incur something that comes with this monster, or at least by the last 3 to 5 years, monster interest rate. By a larger narrative, it's not that bad. But what do you say? How do folks navigate this? What's your advice?
My advice is it's the same advice my parents gave me when I was a kid growing up, which is you have to look carefully at your budget, ask what are these interest payments going to be, and can I afford it given whatever uncertainties there are with my job, or should I hang on with that car just a little bit longer? Should I defer that vacation a little bit longer? So I think just good common sense of knowing your own budget and acting prudently is the right thing to do.
It's so interesting because just last week I saw that credit card debt is soaring in this country. So people are still spending in a way that doesn't jibe with what you just talked about. It'll be interesting and maybe a little concerning to see how those two trend lines collide.
Well, I think that's exactly the point. If the Fed keeps on raising the interest rates that you pay on those credit cards, raising the interest rates that you pay on auto loans, raising the interest rates on, ultimately on mortgages, that will inevitably slow things down because people are just going to be taking a bigger chunk out of their wallet.
Professor Martin Eichenbaum, thank you so much. Really appreciate you sorting this out for us very, very much.
My pleasure. Thank you very much.
Have a great weekend.